Earlier this week, the SEC announced a settlement and substantial fine against Schwab for its robo-advisor services called Schwab Intelligent Portfolio. They were actually fined $187 million. And the reason is because of how Schwab marketed its robo-advisor and specifically what it did with you. And with that, let's get right to it. First, I want to show you Schwab's Intelligent portfolios. Here's from their website. And I'm going to show you sort of what the issue is. It's something I've talked about in the past. We're looking at their aggressive growth portfolio, and you can see that it's 94% stocks, but they then put 6% in cash. And if you select this risk profile, you don't have any choices about that. You have to keep 6% of your money in cash. And if you go less aggressive, the cash balance starts to go up. Slowly at first, it just goes to 7% here. Moderate growth, it jumps to 9. Moderate, it jumps to 12. And actually, if we go, let's go to conservative, it jumps all the way up to 23%. Now, part of the problem with this, there's twofold. One is having that much cash, even 6%, as we'll see in a minute, I'm going to show you, in an investment portfolio can be a real drag on the performance of your portfolio. Now, keep in mind, I'm not talking about the money that you need to spend. Even if you're in retirement, you have a certain amount in your checking account. I'm not talking about that money. And I'm also not talking about an emergency fund. We're talking here about your investment portfolio, which of course is what Schwab Intelligent Portfolios would be holding for someone. So that's what we're talking about, cash in your investment portfolio. And the second thing is, there's nothing like illegal for a robo-advisor to decide to keep some money in cash. The issue dealt with disclosures because Schwab described itself as being a free service, and it described itself as constructing the portfolio effectively based on the best interests of the investors. And that's sort of what, as we'll see in a minute, the SEC had trouble with. Now, I wrote about this some time ago. I have an article, I'll link to it below the video, on what I think are 4 of the better robo-advisors. For me, Betterment's probably the best all around, but I talked about Schwab in this article. I'm just scrolling down to it. Here we go. Here it is, Schwab Intelligent Portfolios. And I talked about it then. Schwab forces you to keep at least 6% of your portfolio in cash, and that's how Schwab makes its money. And the amount of cash you must keep goes up as your portfolio becomes more conservative. And I showed one example of it here, and that was a real problem. And it's why Schwab didn't make my list of the best robo-advisors. And that brings us then to the SEC order. They released it just this week. You can see Schwab was forced to pay, or agreed to pay, $187 million. And the reasons are described in this paragraph right here. They say, from 2015 to 18, Schwab's mandated disclosures for its robo-advisor products stated that the amount of cash in the robo-advisor portfolios was determined through a, quote, disciplined portfolio construction methodology, and that the robo-advisors would seek, quote, optimal returns. In reality, Schwab's own data showed that under most market conditions, the cash in the portfolios would cause clients to make less money. So that was a big problem. And it went further. They actually, as you can see here, used investors' money to profit. They would sweep the cash out of the portfolios, lend it, and then they would keep the difference. So effectively, as I read this, investors' money was being put at risk in theory through these lending activities, but the investors didn't get to keep the profits. Schwab kept the profits. So that's a real big problem. And they got caught and they got fined. And we'll see how things change at Schwab. But now that raises a big question for us as investors, whether we use Schwab or not, whether we use a robo-advisor or not. How does cash really affect an investment portfolio? And this problem comes up more than you might think, because mutual funds tend to have some amount of their assets in cash. That's particularly true with actively managed mutual funds. They can hold a significant amount in cash, which can be a real drag on performance. So let's take a look at what that might look like. And I want to use Portfolio Visualizer. What I've done here to start with, I just want to compare 2 portfolios. The first one is just a total US bond market, 100%, and the second one is cash, to show you the difference between investing in say, intermediate term bonds, which is what a total U.S. bond market fund would have, versus cash. And so I ran these numbers, and it goes back about 35 years. And you can see the numbers are pretty significant. If we started with 10,000, and again, this is certainly a long-term investment, but look at the difference. The bond market returned 63% and cash 28%. And the compound annual growth rate, the difference is pretty significant, 5.33 versus 2.96. Now, of course, it's not all a walk in the park. As we can see more recently, this year, bonds have fallen significantly. So if we looked at the last 6 months, I think all of us would rather have been in cash than just about any other investment out there. But long term, there's no doubt that a bond fund, say an intermediate investment grade or U.S. government bond fund, is going to outperform cash. And that's a big problem if we're holding a lot of cash in our portfolio. So then I thought, well, but how bad can, say, even 6%, if we go to this aggressive growth, how bad can 6% be? And so I tested it in a couple of different ways. I first started with just a 3-fund portfolio. So this does include bonds. And I then said, okay, well, what if we added cash and subtracted that from bonds? Well, how would that affect the portfolio? And then what if we added cash but subtracted it from the U.S. stock market? And when you run the numbers, again, this is over a long period of time, but you can see this cash drag. Without the cash, we're at 170,000. With cash coming out of the bond portion of the portfolio, we're at 163. And if it comes out of the stock portfolio, we dip below 150,000. More importantly, you can see how the compound annual growth rate drops as we do that. And it probably gets worse. I didn't actually run these numbers, but let's do it now. Let's imagine we had a portfolio. We'll just make it, to keep things simple, we'll just keep it 100% stock market. We'll clear portfolio 3, and here we'll do 94% U.S. stocks and 6% cash. Just nice and simple. This would kind of mirror this, although I assume the stocks for Schwab would include some international exposure, but we'll just keep it simple, the same concept. If we analyze this, you can see a pretty significant difference over time. If you looked at just the compound annual growth rate, you'd say, well, it's what, about 25 basis points. It doesn't seem that significant, but over a lifetime of investing, you can see this is 35 years. It makes a significant difference. So what's the takeaway? Well, for Schwab, being forced to include even just 6% in cash over long periods of time is a significant cost. It's why Schwab didn't make my best robo-advisor list, because I didn't like the fact that they advertised it as free, because it's not free. There's a cost. It was just that, unlike, say, a Betterment, which is very upfront, they say, okay, 25 basis points is your cost. Is Betterment for you or not? With Schwab, it was very hard to figure out exactly what your costs would be. But even putting Schwab aside, for your own investment portfolio, really think about, if you have cash, understand, yes, it may give you some sense of security, but it will come at a cost long term. You still may decide to keep some amount of cash in your investment portfolio, but at least you can now do it understanding the effect it may have on your returns over a long period of time. Well, there you go. I hope this has been helpful to you. If you have any questions, leave them in the comments below. Be happy to help you out any way I can. And until next time, remember, the best thing money can buy, it turns out, it ain't cash. It's financial freedom.